Welcome to Ace My Exams Learning. Let us get started with today's learning.
Financial feasibility. A financial feasibility study is a crucial step in the process of evaluating the potential success and profitability of a business venture. It involves a comprehensive analysis of the anticipated costs and expected revenue to determine whether the business is sustainable in the long term to generate profits and cover its expenses. The startup costs for a business. The cost of starting a business can vary significantly depending on factors such as the industry, business model, scale, location, and regulatory requirements. Here are some common expenses to consider when estimating the cost of starting a business. 1. Business registration fees, including permits and licenses. 2. Office setup costs, consisting of rent or lease deposit. Office furniture and equipment such as computers, printers and phones. 3. Technology and software expenses, such as software licenses, website development and hosting. 4. Inventory or raw materials, to include the initial inventory purchases or raw materials for manufacturing. 5. Marketing and advertising costs, which may include logo design and branding, marketing materials such as business cards, flyers and brochures, social media paid ads and traditional advertising. 6. Transportation and travel expenses, such as vehicle purchase, lease or travel costs for business trips or meetings. A startup may also require additional funds to cater for miscellaneous expenses such as office supplies, maintenance and repairs, membership dues and subscriptions. Establishing product cost and pricing. Once you have identified a profitable business idea and developed a product, the next step is to establish the cost of producing your product and the price you can sell it for. To achieve the above, the following considerations need to be undertaken. 1. First, you need to assess the costs associated with your proposed business, including direct costs for producing your product and indirect expenses such as marketing, administrative overheads, etc. 2. Calculating the break-even point is essential. This highlights the level at which total revenue equals total costs, indicating the minimum sales volume required to cover all expenses and begin generating profit. 3. Thirdly, explore the available financing options and determine how to fund your business venture. This may involve self-funding through personal savings or external financing from investors or lenders. 4. Additionally, learn how to calculate your profit. Knowing how much you can profit allows you to gauge the financial performance of your business. 5. Lastly, analyze the pricing strategies used by your competitors and use this information to position your products effectively in the market. This includes evaluating pricing models, pricing levels, discounts, promotions, and value-added services offered by competitors to inform your own pricing decisions. Sales and profits. Sales represent the revenue generated from selling goods or providing services to customers. On the other hand, profits reflect the net income or earnings after all expenses have been deducted from the total revenue. The selling price. The selling price is the amount customers are willing to pay to acquire a product or service from a business. It is a key component of pricing strategy and is influenced by factors such as 1. Cost of goods sold. This represents the direct costs incurred in producing or acquiring the products. It includes expenses such as purchase price, manufacturing costs, and transportation. 2. Customer demand and perceived value. The selling price is also influenced by how much customers are willing to pay for the products or services. Costs. Costs are an important aspect of any business. There are two main categories of costs, namely fixed costs and variable costs. Variable costs. Variable costs are those costs that fluctuate with production and sales volumes. For instance, if you operate a bakery, the expenses associated with purchasing packaging materials and raw ingredients would be considered variable costs. If you produce more baked goods, you'll need to buy more packaging materials and raw materials, whereas if production decreases, you'll require fewer supplies and incur lower costs. These variable expenses are commonly referred to as cost of goods sold since they directly represent the cost of producing the goods sold by the bakery. Fixed costs, on the other hand, are those costs that remain constant every month, regardless of variations in sales. They include salaries, rent, and electricity. Gross profit percentage. Gross profit percentage represents the gross profit of a business as a percentage of its sales. We use the formula below to calculate the gross profit percentage. Gross profit percentage is equal to gross profit divided by sales, multiplied by 100. Let's use the example below to calculate Del Bakery's gross profit and the gross profit percentage. Del Bakery sells cakes. In March, the bakery generated 10,000 Rand in sales revenue. The cost of ingredients, labor, and overhead expenses directly related to producing the cakes amounted to 6,000 Rands. Calculate the gross profit percentage. Gross profit is equal to sales minus cost of goods sold. Hence 10,000 Rands minus 6,000 Rands is equal to 4,000 Rands. Therefore Del Bakery's gross profit for March is 4,000 Rands. Now that we got the gross profit of Del Bakery, let's calculate the gross profit percentage using the formula below. Gross profit percentage is equal to gross profit divided by sales, multiplied by 100. Hence 4,000 Rands divided by 10,000 Rands multiplied by 100 is equal to 40%. Therefore Del Bakery's gross profit percentage is equal to 40%. Read the information below and answer the questions. John runs a spaza shop. His forecasted sales for the month are 2,500 Rands, and his fixed costs are 350 Rands per month. He calculated that he needed to buy goods to the value of 900 Rands to generate the forecasted sales figure. Question. Calculate the gross profit and the net profit for John. Gross profit. Gross profit is the difference between sales revenue and the cost of goods sold. To calculate the gross profit of John's spaza shop, we'll take the forecasted sales and deduct the cost of goods sold to find the gross profit. We shall use the formula below. Gross profit is equal to forecasted sales minus cost of goods sold. Therefore, 2,500 Rands minus 900 Rands is equal to 1,600 Rands. Hence the gross profit of John's shop is 1,600 Rands. Net profit. Net profit is the remaining profit after deducting all expenses, including fixed costs, from the gross profit. To achieve the above, we will use the formula below. Net profit is equal to gross profit minus fixed costs. Therefore John's profit is 1,600 Rands minus 350 Rands, which is equal to 1,250 Rands. Question. Calculate the gross profit percentage and net profit percentage for John's spaza shop. Let's calculate the gross profit percentage using the following formula. The gross profit percentage is equal to gross profit divided by the forecasted sales and multiplied by 100. Therefore, gross profit percentage is equal to 1,600 Rands divided by 2,500 Rands and multiplied by 100, which equals 64%. Net profit percentage. John's net profit percentage can be calculated as follows. Net profit percentage is equal to net profit divided by the forecasted sales and multiplied by 100. Therefore net profit percentage is equal to 1,250 Rands divided by 2,500 Rands multiplied by 100, which equals 50%. Question. You are given the following information. 80% of every 1 Rand sales is a contribution towards fixed costs. Fixed costs amount to 500 Rands per month. Calculate the break-even point in Rand value. The break-even point is a critical financial metric used in business to determine the level of sales needed to cover all fixed and variable costs, resulting in neither profit nor loss. In the above scenario, we are provided with two pieces of information. 1. The contribution margin ratio. This represents the proportion of each unit sale that contributes to covering fixed costs and generating profit. It is expressed as a percentage. In this case, it is given as 80%, which means that for every rand of sales, 80 cents contribute towards covering fixed costs and generating profit. 2. Fixed costs. These are expenses that do not vary with the level of production or sales. They remain constant over a specific period regardless of the business's activity level. Examples include rent, insurance, salaries, and utilities. In this scenario, fixed costs are stated as 5,500 rands per month. To calculate the break-even point in rand value, we use the break-even point formula below. Break-even point is equal to fixed costs divided by contribution margin ratio. Let's substitute the given values into the formula. 5,500 rands divided by 0.80 cents. Therefore, the break-even point in rand value is 6,875 rands. This means that the business needs to generate sales of 6,875 rands to cover all fixed costs and reach the break-even point, where it neither makes a profit nor incurs a loss. Any sales revenue beyond this point contributes to profit. Question. Calculate the break-even point in units if the business has a product with a selling price of 350 rands and a variable cost of 120 rands. The profit goal is for 500 rands. To calculate the break-even point in units, we'll use the formula. Break-even point in units is equal to fixed costs plus the profit goal divided by the contribution margin per unit. First, let's determine the contribution margin per unit, which represents the amount of revenue per unit available to cover fixed costs and contribute to profit after deducting variable costs. To achieve this, we shall use the formula. Contribution margin per unit is equal to selling price per unit minus the variable cost per unit. Given that selling price per unit equals 350 rands, variable cost per unit equals 120 rands. Contribution margin per unit is equal to 350 rands minus 120 rands, which is equal to 230 rands. Now, let's calculate the break-even point in units using the given fixed costs and profit goal. Fixed costs are equal to 5,500 rands. Profit goal is equal to 4,500 rands. We are going to use the formula. Break-even point in units is equal to fixed costs plus the profit goal divided by the contribution margin per unit. Therefore, break-even point in units is equal to 5,500 rands plus 4,500 rands divided by 230 rands. 5,500 rands plus 4,500 rands is equal to 10,000 rands. When we divide 10,000 rands by 230 rands, we get 43.48 units, which can be rounded to 43 units.
To access more learning and exam preparation materials, go to www.acemyexams.coza. This link is also in the video description below. Thank you for watching this video. Remember to subscribe and be the first to know when we upload new videos.